Hello, everybody. I'm so glad you're back with me. We are going to continue on to Chapter 18 today. I think I assigned you some homework from the book and a handout. Is that right? Yeah. Okay. Let's go ahead and go through 18.1 first. Exercise 18.1 from the book. Now, the question is here on the screen, and this is kind of one of those questions that you maybe you don't know what wording they want you to put in there, or maybe your wording is different or whatever. But let me go ahead and show you the answers to that, and you might have different wording. That's okay. The main reason I assign something like this is so that when you go over and do your review your homework as we get closer to a test, you'll know that I think that this was important enough to assign a homework problem over. Make sense? So you can kind of see what they say in regards to financial and managerial accounting, okay? Time dimension, financial looks at historical. Managerial looks at historical, but it also looks into the future. Financial has external users, whereas managerial, it's more internal users. Financial accounting, a lot of times the information is only available after the audit is complete, and it's just looking in the past, whereas with managerial, there's no need to wait for an audit, okay? We talked about the purpose as far as external versus internal for financial and managerial, respectively. Financial mainly has monetary information, whereas managerial has non-monetary as well. Flexibility. Financial accounting is very structured, a lot of rules, but managerial is very flexible, okay? Not a lot of rules. And the focus of the information on financial is usually the whole organization, whereas with managerial, you may focus on the whole, but you may focus on just smaller segments of it as well. Cool? Any questions there? Okay. Let's go ahead then and take a look at exercise, thank you, handout 18.1, okay? Now, before we go over that, let's do just a little bit of review, okay? We talked about how there's product costs and there's period costs, right? There are three product costs. There are direct materials, there's direct labor, and there's manufacturing overhead, right? We talked about if you see one of four words in a cost item description, you can come off that. If you see one of four words, you know it is a product costs. Now, not all product costs have these words in them, but if you do see these words, you know it is a product cost. What were those four words?
Factory, manufacturing, assembly, and production.
Factory, assembly, production, and manufacturing. Or any derivations of those words, right? Like assembling or something like that, okay? So, and then there's product costs, and then what was the other category of costs? Period costs. Those are non-factory costs, like general administrative and selling, okay? All right, let's go ahead and go through this handout real quick. One of the most important things, and we're going to talk about why, is being able to properly differentiate and classify between product and period costs, okay? So let's go through this, all right? Let's go ahead and read the top part here. Suppose that you have been given a job at Fairwing Avionics, a company that manufactures sophisticated radar sets for commercial aircraft. The company, which is privately owned, has approached a bank for a loan to help finance its growth. The bank requires financial statements for the loan. Classify each cost below as either product or period cost for the purposes of preparing financial statements for the bank. Okay, first of all, what I want you to do, and then it says something else here, but let's do the first step initially here. Let's just go through these and decide if it's a product or a period, okay? All right, the cost of memory chips used in a radar set, what is that? That's a product cost, okay? Factory heating costs, product. Training costs for new administrative employees,
Period.
That's a period cost, okay? The cost of the solder that is used in assembling the radar sets.
Product.
Product. See that word assembly or assembling. The travel cost of the company's salespeople.
Period.
period. Maintenance costs on the assembly equipment.
Product.
Product. Wages and salaries of factory security personnel.
Product.
Product. The cost of air conditioning the executive offices.
Product.
Period.
That's period, isn't it? The cost of air conditioning the executive offices.
That's not in the factory. I got you.
Yeah. Now, if it was air conditioning the factory, it'd be product. Okay. Wages and salaries in the department that handles customer billing.
Period.
That's period as well. Okay. Depreciation on the equipment in the fitness room used by production workers.
Product.
Product. Telephone expenses incurred by factory management.
Product.
As soon as you see that word, the discussion's over, isn't it? The cost of shipping completed radar sets to customers.
Period.
Period.
That's period. Now, sometimes people think that shipping costs are product costs. No, they're period costs. The products have been completed, and it's really part of selling them, isn't it? Shipping them, okay? All right, the wages of the workers who produce the radar sets.
Product.
Product.
Product, right? The president's salary.
Period.
Period.
Health insurance premiums for factory personnel.
Product.
Product. Very good. Any questions on any of those? Okay. Now let's do the second part of this. If the cost is a product cost, further classified as direct material, direct labor, or MOH. Okay? You with me? So we're going to go through on the product cost and decide if they're direct material, direct labor, or manufacturing overhead. Okay, the cost of memory chips used in a radar set. What's that?
Direct materials.
That's direct material. Factory heating costs.
MOH.
Manufacturing
It's
overhead.
MOH, and a lot of times I arrive at the decision that it's manufacturing overhead because I've decided it's a product cost. Then I ask myself, well, is this direct materials? Well, no. Is it direct labor? Well, no. Well, then it has to be MOH, right? A lot of times you arrive at it's MOH because I know it's a product cost, it's not direct materials, it's not direct labor, okay? Next product cost. The cost of the solder that's used in assembling the radar sets.
Direct
Direct
labor.
material.
That is direct materials, isn't it? Okay. Okay. Down here. Maintenance costs on the assembly equipment.
MOH.
It's got to be MOH. Okay, or factory overhead, same thing. Wages and salaries of factory security personnel.
MOH.
MOH. This is not direct labor because these folks are not putting the product together. Okay? All right. What's the next product one? Depreciation on the equipment used in the fitness room used by production workers.
MOH.
That's MOH. Telephone expenses incurred by factory management.
MOH.
Good. 13, the wages of the workers who produce the radar sets.
Direct
Direct
labor.
labor.
That is direct labor, right? Sometimes they're called direct labor, touch labor. These are the people who actually are touching that product, putting it together, doing the drilling and the sawing and all that sort of stuff. Health insurance premiums for factory personnel.
MOH.
Direct labor.
I left this one for last. I'd probably say MOH, although I have seen some companies that health insurance for the direct laborers, they would actually include that in direct labor. Remember when I said managerial accounting had more gray areas in it, whereas financial accounting was black and white? This is probably one of those gray areas. But I would probably, if had to choose one, I'd say MOH. Okay? Cool. Any questions on any of that? Was that a lot of fun? A lot of fun to do?
Mm-hmm.
Yeah, good. I like to provide fun in your life. Okay. Okay, no questions? We're going to continue on, and we're going to talk about why is it so important to be able to differentiate between product and period costs. Now, one thing that sometimes people think during this chapter is they think, well, we're learning about all this manufacturing stuff. Is there really manufacturing that occurs in the United States anymore, right? Well, there is. Now, I will agree that a lot of manufacturing is now overseas, and manufacturing is not near as large a part of the economy as it used to be, 60, 70 years ago. What is the sector of the economy that's grown in the United States?
Technology and communication.
And service, okay? Services. So the next slide points out something that's important. These concepts that we're learning are useful for service companies as well, okay? They are useful for service companies as well. It's not as cut and dry how they are, so we do that a lot more in managerial accounting. We do focus on the manufacturing in accounting too, but these are useful for service companies. So keep that in mind as we go through this, all right? Okay, we have our product costs, okay? Now, another thing I want to point out real quick is these terms that you should know called prime costs and conversion costs. Prime costs and conversion costs. If we add direct materials and direct labor together and treat those kind of as one, those are our prime costs, okay? So if your direct materials were $12 per unit and your direct labor was $14 per unit, and let's say your MOH was $30 per unit. Well, some companies would just differentiate, well, what would our prime costs be? 26. Our prime would be 26, and then we would say MOH is what, 30? And they would do everything in this way. And they classify these together sometimes because they're both direct. Okay? So some companies do it that way. Okay? Now, let me get rid of my writing here. Go back to that slide. Okay? There are other companies that, where'd my other box go? There we go. Okay. There are some companies that treat these two items together. Okay? What did I say direct materials were?
12, 14.
Oh, direct material is 12.
12, 14, and this was 30.
Yeah.
So if you classify your direct labor and your MOH together, that is called conversion costs. Okay? So there might be other companies that say our direct materials are $12 per unit. Our conversion costs are $44. Is that right? Is that right? Okay. And that still adds up to 56, correct? Mm-hmm. Now, we'll talk about we'll talk about in the next chapter why they sometimes put direct labor and manufacturing overhead together. But I want you to know that there are companies that do it those ways. You with me? Okay. Luke.
Companies would never do it both ways because then that'd be like double counting the direct labor.
That's a great question, Luke. That's a great question. He asked, would company do it both ways? No, probably not. Probably not. They would either go direct material and conversion, or they would go prime and MOH. Okay, so very good question. All right, let's go on. Here is the crux of why it is so important to differentiate between product versus period costs. Oh, this is important. This is so important. Okay? Product costs, as we are going to learn, initially go into inventory accounts. And we're going to learn about those inventory accounts today. They go into various inventory accounts. Now, inventory accounts are assets, right? Assets are on the balance sheet. So those costs go into inventory accounts for a while in these on the balance sheet, and it is only if and when the product is sold that those costs move over to the income statement through the item of cost of goods sold. Do you follow that? That's for product costs. Period costs, boom, they go straight to the income statement. Okay? Now, hopefully all costs will eventually get to the income statement, but period costs, boom, they go straight there. Product costs work their way through the inventory accounts first on the balance sheet, and only when they are sold do they go to the income statement through cost of goods sold. This is just so mucho importante, which is Spanish for very, very important, okay? This is so important, okay? Let's talk about this more. So the primary distinction between product and period costs are product costs are what we call inventoriable. Inventoriable, okay? So we're going to work on that concept today, okay? Now, I have here an illustration here, but before we look at this slide, we'll come back to it. I want to examine and look at some new concepts, okay? So let's go back to the slides here. Let's differentiate and remind ourselves the difference between merchandisers and manufacturers, okay? Merchandisers we learned about in Chapter 5 of Accounting 1. Those are companies that they buy finished goods and then sell those finished goods. They do not manufacture the goods. They just buy them from a manufacturer and then they sell them. This would be like Walmart or Kohl's or Best Buy, correct? Those are merchandisers. Manufacturers, on the other hand, they purchase raw materials and then they manufacture or produce and sell finished goods, such as Garmin or a Ford Motor Company, right? Okay? Now, how does the balance sheet of these two different types of businesses differ? Well, the only difference really is inventory. Merchandisers only have one type of inventory, and it's called merchandise inventory, okay? Manufacturers, on the other hand, have three types of inventory. They have raw materials inventory, they have goods in process inventory, and they have finished goods inventory. Now, all of these are inventories, and they're all assets, okay? But manufacturers have three types of inventory. Let's talk about those. Raw materials are those materials that are waiting to be processed, like tires at an auto manufacturer, okay? There is what is known as goods in process, which is also known as work in process inventory. So goods in process inventory and work in process inventory, same thing. And I'll use both terms, and sometimes I won't realize which one I'm using. But these are partially completed items. You can see that photo down there of an auto that's going through the assembly line at an auto plant. And they've started to put it together, but it's certainly not done, is it? Okay? That is goods in process or work in process inventory. And then, of course, there are finished goods. These are goods that they are done and they are ready for sale. You with me? So three types of inventory for a manufacturer. Cool? Okay, now let's go back to that flow statement that we saw initially. Okay, let's take a look at this. This is a really important slide as well. So put some stars there, okay? Okay, follow along with my pointer here. We have some costs that are incurred in 2014. We have a lot of costs that are incurred in 2014, right? Some of those are period costs. And if they are period costs, boom, they go straight to the 2014 income statement as operating expenses, okay? Now, some of those costs incurred in 2014 are instead product costs, Okay, and we did a worksheet on identifying between these. Well, these product costs initially go into these inventory accounts. Raw materials, goods in process, or finished goods, right? Well, if that inventory is finished and sold in 2014, then it does move to the 2014 income statement through cost of goods sold. If that inventory is sold. Well, what if the inventory, however, is not sold in 2014? Well, then those costs will be hanging around on the 2014 balance sheet in the inventory accounts. Those three, the raw materials, the goods in process, and the finished goods. Now, when those goods are sold, let's say they're sold in 2015. Sold in 2015. Well, then they finally make their way to the 2015 income statement through cost of goods sold. Very important. Jeremiah, do you have a question?
Yeah. So what if it's like factory heating costs? That's like MOH. So what would that be? That's not inventory.
That's a very good question. Very good question. He asked what about like factory heating? Well, it's a little hard to answer that because it's chapter 19 concepts, but let me give you a little preview of things to come. Take a look at the slide. We can see how this works very easily with raw materials. But what we're going to find out is for direct labor and manufacturing overhead, of which factory heating costs would be the latter, what we end up doing is allocating it or assigning it to goods in process inventory. Okay? So that's how it ends up in the inventory count. That's kind of hard to understand now because we haven't gone through it yet, but that's how it gets there. Great question. Great question. Okay? All product costs go through the inventory counts, not just materials. Very good question. Okay, any other questions on this very important diagram? You'll use this diagram a lot in Managerial as well, so it's good to know. Okay? Okay, now let's talk about we talked about how the balance sheets differ between the merchandiser versus the manufacturer. Let's talk about how the income statement differs. Okay, first of all, let's take a look at a merchandiser. How do you compute cost of goods sold for a merchandiser? Well, it is shown here, and actually, I think I kind of want to do this separately on the Elmo. So let's do that, okay? For a merchandiser, this is chapter 5 of Accounting 1. If you had me in Accounting 1, we had a quiz over this, right? We took the beginning inventory plus purchases, and that equals, what does that equal, remember?
No.
That equals goods available for sale. This is for merchandiser. Then we subtracted ending inventory, and we got cost of goods sold. You remember that? Was anybody going to tell me that I'm writing and it's not on the screen? Who was getting ready to tell me that? Okay, don't hesitate to tell me that, okay? Merchandiser, beginning inventory plus purchases equals goods available for sale minus ending inventory equals cost of goods sold. Do you guys remember that? Okay. Now let's talk about how do we arrive at cost of goods sold for a manufacturer. Okay. Well, we start with beginning inventory, but didn't I say with a manufacturer that there's more than one type of inventory? So we need to be sure to differentiate what inventory we're adding, what beginning inventory. Well, it's the beginning inventory of finished goods. So we take the beginning inventory of finished goods and we add it to something. Now, for a merchandiser, we get more items by purchasing them, right? For a manufacturer, we don't purchase the items we sell. What do?
Manufacture.
We manufacture them. So we are going to add something called, and I'm going to abbreviate here, cost of goods manufactured. This is a new term. Cost of goods manufactured, okay? And that equals goods available for sale, okay? Then we subtract out, once again, ending inventory, but once again, there's more than one type of inventory for a manufacturer, so we have to specify which one. Which kind? You want to take a guess? Finished goods. Okay? So, this is important. As a matter of fact, we're going to have a quiz over this, not next period, but the period after that, for you folks here who are face-to-face. Okay? I want you to know these two cost of goods sold equations. For merchandiser, beginning inventory plus purchases equals goods available for sale, minus ending inventory equals cost of goods sold. For manufacturer, it's the beginning inventory of finished goods plus cost of goods manufactured equals goods available for sale, minus ending inventory of finished goods equals cost of goods sold. You ready? Cool. Questions? Now, if you go to that slide, let's go back to that slide. They put the same thing here on this slide. I just kind of like the way that I do it a little bit better. Okay? All right? Now, and you can see how that would look more with, numbers in them. Okay? Now, we have this new term here, don't we? We have this new term here called cost of goods manufactured. We haven't talked about that before. What is cost of goods manufactured? Well, in its simplest form, cost of goods manufactured is what is shown on the screen there, okay? Which is direct materials used plus direct labor plus factory overhead or manufacturing overhead, same thing. And then we add the beginning work in process or beginning goods in process, and then subtract out the ending work in process or the ending goods in process. And that gives us COGM. I really don't like this slide very well. What I highly prefer is take a look in your textbook at Exhibit 1817, okay? And it is on page, in my book, it's page 748. I'm not sure if it's the same page for you all, okay?
What was it, 1817?
Yeah, Exhibit 1817, and is it on page 748 for you all as well? Okay? Put a star by this. Lots of stars today, right? This is, look at the bottom line here, is cost of goods manufactured, right? This is what is called a manufacturing statement, or sometimes we call that the cost of goods manufactured statement, okay? And it is how we arrive at this number of, or this item of cost of goods manufactured, okay? Now, you'll have to prepare one of these on your test, so I want to make sure you understand here. But I like this exhibit because it highlights that there are 4 steps to doing a cost of goods manufactured statement, okay? And the first 3 steps have to do with the first 3 product costs: direct material, direct labor, and overhead, okay? Let's concentrate on those 4 steps, okay? Let's see if we can zoom in a little bit on each step. Okay, the first step, direct materials, okay? Now, we're assuming in this that all raw materials are direct materials, okay? And all direct materials are raw materials, okay? Well, we take the beginning inventory of raw materials, okay, plus our purchases of raw materials, and that gives us our raw materials available, okay? Then we subtract out our ending inventory of raw materials, and we get direct materials used. In this case, that is 85.5, okay? You see how we did that? The next step, that was step 1. What's the step 2? Step 2 is easy. All it is you add the direct labor. It's easy because you can't inventory labor, can you? Right? So we've done step 1 was to figure out how much the direct materials used were. Then we figured out our direct labor. The third step has to do with the third product cost, factory overhead. And what you can see here is they list out a bunch of items, okay? They list out a bunch of items that are factory overhead. Let's go through those. This is a good reminder. Indirect labor is factory overhead, right? Factory supervision, factory utilities, repairs on the factory equipment, property taxes on the factory building, factory supplies used, factory insurance expired, depreciation expense on the small tools. No doubt those small tools were used in the factory. Depreciation expense on the factory equipment, depreciation expense on the factory building. Now they have this one, and I think this is a little vague. I wouldn't do this to you. Amortization expense on patents. Now I don't know what those patents are on, but let's just assume it's factory equipment. Okay? Well, those are all factory overhead items, aren't they? Okay? Those are all factory overhead items. And we add those items up and get our total factory overhead. Okay, we got a little bit of a glare going there, don't we? Okay. And then we add direct materials used, direct labor, factory overhead, and we get this number of 175,500. Okay? Now, a lot of people make the mistake and they stop here and they say that's COGM. That's cost of goods manufactured. That's not cost of goods manufactured. That's total manufacturing costs. What we have to do is we take these total manufacturing costs and we add the beginning inventory of goods in process, and then we subtract the ending inventory of goods in process inventory, and we get COGM. Let me say that again. We take the manufacturing costs, we add beginning inventory of goods in process, we subtract the ending inventory of goods in process, and we get COGM. You with me? Now, I'm going to give you, what we're going to do here now is we're going to work in class a little bit. And we're going to prepare a cost of goods manufactured statement. And they're going to give you a bunch of these items, and you have to kind of put it in the format that they're showing here. Okay? Here's what I want to work on in class. Okay? Exercise 18.8. It's on page 763. Now what it says is use the following data, compute the cost of goods manufactured and the cost of goods sold. Now I only want you to, let's just work on, just ignore the information for for Culpeper Company, I'm sorry. Ignore the information for Culpeper Company. What I want to do is what they're asking for Garcia Company, okay? I want to do what they're asking for Garcia Company here in class. They're going to roll that music here in a second. Now, I do want you to note that they have some check figures for you for Garcia. The cost of goods manufactured should equal 96,680, and the cost of goods sold should equal 91,030, okay? So we are going to work on this in class, okay? Now, they're going to roll the music, folks at home. Probably about 3 minutes into this, folks at home, take a look at the screen. I'm going to show you what the top section looks like. If you're just absolutely stuck, it'll kind of help you get started, okay? But let's go ahead and and I don't want you just to compute the number. I want you to write it out like that exhibit we were looking at. So let's go ahead and work on, for Garcia Company, this data and exercise 18.8 while they roll the music, all right? Okay, folks at home, just pause us if you're not done. Start us up when you are. I know the first time you go through these, it's kind of a little difficult. So let's go ahead and look through the answer for Garcia. Again, concentrate on those 4 steps. The first step in regards to direct materials is shown as follows. Okay, I won't read that to you. I know you know how to read. Okay. All right. Now the second step has to do with direct labor, right? So then you list out direct labor, right? Okay. Then you do your factory overhead, okay? And you get your factory overhead. That's the third step, okay? All right. Okay, any questions on the first 3 steps before I go on to the 4th step? Did we put general administrative in here? We didn't. Why did we not do that? That's correct. Why did we not do that?
Period cost.
Because that's a period cost, okay? All right, so then what you do is you add the direct materials used, the direct labor, and the factory overhead, and you get an amount of 104,180. Now that is not COGM, is it? That's not COGM. That's what we call total manufacturing costs. Then what we do to get COGM is we add the beginning inventory of goods in process, and then we subtract out the ending inventory of goods in process. And there we get COGM. Is that correct? So there's the 4 steps. 1, 2, 3, 4. Okay? Now, it also asked you to do something else besides this, didn't it? What was the other thing it asked you to do?
Cost of goods sold.
Figure out cost of goods sold. So let's take a look at that real quick. You might have not done that. This goes back to those slides I was writing on the Elmo and telling you we were going to have a quiz over. Okay? Now, of course, this is not on the manufacturing statement right here. This is on the income statement in the cost of goods sold section. But remember, we take COGM, we add it to the beginning inventory of finished goods to get cost of goods available for sale. Then we subtract out the ending inventory of finished goods, and we get cost of goods sold. Okay? Do you remember that? Let's switch over to the computer real quick. Remember there on the right side? Okay, in the pink? That's what we're doing here, okay? So that's how we figure out cost of goods sold. This is all for Garcia Company. Okay? So are there any questions on that? Any questions, folks? Okay. Take a look at that. Show that up there for just another 15 seconds or so. All right. Yeah, Luke.
I was wondering, like when we're listing all of the, all of the
Factory overhead items?
Yes. Do we have to say like less ending goods in process, or can we just list it like positives and negatives, like a cash flow?
Well, you want to state that this is the beginning goods in process inventory.
Right.
And you want to state that that's the ending goods in process inventory.
Right. I just didn't know if we had to like list total cost of goods in process. And then
Well,
like,
that's a good question. I think it's probably good to do it. I mean, just because people kind of expect it. Okay? And so, even though this isn't for external users, it is for internal users. And so it's kind of it's easier just to do it the way that people expect it to be. So I'd probably say yeah. I mean, I wouldn't take off on a test, but I'd try to get in the habit of listing subtotals such as this one and this one. Okay? All right, questions, folks? Okay, let me give you your homework assignment. One of the homework assignment, and I'm going to show you here, is exercise 18.6. Now, I'll give you your full assignment here in a second, okay? Now, I want you to make sure when you do exercise 18.6 that you read these instructions and do this in the order that they say. They say, first of all, they want you to classify each cost as a product or period cost. So, these books are yours to keep. I might just go through these and decide if they're a product or period cost. Okay? Kind of like we did on the handout. Then what it says is, if it is a product cost, identified as direct material, direct labor, or overhead. So I might do that just like we did the handout as well. For the product costs, go through and write if it's DM, DL, or MOH. Okay? And then once you do that, then the direct material items, I would put a check mark in this column because they want you to notice that it's a prime cost. If it's a direct labor, you'd actually check both of these because it's part of prime and part of conversion. Okay? And if it's overhead, you would check in this column. Now, if it's a period cost, you'd put a check mark in this column. And then after you do that, they want you to, for every product cost, they want you to classify it as direct or indirect, just for the product costs. And that goes back to, we talked in the slides about indirect and direct costs. Okay? So read those instructions on 18.6 carefully. Here is your full homework assignment. Now, the quick studies are really quick. These in total won't even take you 4 minutes. Okay? These are really quick. So I want you to do quick study 18.6, 18.7, 18.8, and 18.11. That won't take you long at all. Then do this exercise 18.8, and I told you the instructions. Read those carefully. Do 18.7, and then, you know, 18.8 we just did, but we did Garcia Company. Remember that in class? We just did it. Now I want you to do Culpeper Company, the same thing for 18.8. Do that part as homework. Okay? You with me? All right, guys. Have a good one. We'll see you later. Bye-bye.